about a history lesson that is valuable for you to understand so that you can make the best financial decisions. We're talking about the facts leading up to a decision in 1988 by the US government that prevented wealthy people from using a tax shelter and called it instead a terrible investment. The reason you need to know is that as we make decisions about how to keep and control more of our money, we want to understand the landscape that we're playing in and the facts of the circumstances leading up to what is the best place to store cash and capital, and why the government would say it's so good that we have to prevent people from putting so much money here. So Bruce, I'm really excited for this conversation. Yes, we often talk about infinite banking and how to apply that to our lives today, but I think it's really valuable to take a snapshot of this particular lesson from history leading up to what's called the MEC laws, or the MEC rule in the Tamra Act in 1988. So Bruce, thank you for joining me for this conversation today.
Yeah, this is an important topic for people to understand, but it is kind of a topic that's behind the curtain. In other words, this is the technical analysis that the life insurance companies do to make sure that the policy performs the way that you would like it to perform. And sometimes you actually want it to become a mech. And we'll talk about that towards the end, I think. But there were two precursors to this act, which called the Tax Reform Act of 1986 and the Revenue Act of 1987. And this was Congress in the 80s way to try to stimulate the economy after it had bogged down after massive inflation in the late 70s and early 80s. And I'd like to remind everybody that this is not a tax loophole. You know, we do not like the word loophole. There's nothing in the tax codes that ever say this is a loophole. That is a term that people that are trying to get more benefits for other people and take benefits away from other people are trying to use a negative terminology to drive behavior, where Congress actually puts tax incentives into the tax laws, and that tax incentive drives human behavior that they actually want to be driven. Example, the Tax Reform Act of 86, I believe it was, actually changed a lot of the deductions. One of the deductions that was changed was you used to be able to deduct all your interest, like car interest, sales tax interest, credit card interest from your taxes. And Congress was trying to keep um, uh, uh, human credit limits down. So they said we're not going to deduct that anymore because they felt that that was actually hurting the economy, because people were actually paying a lot of interest because they could deduct it instead of actually putting that money back into the economy. So they're always trying to drive what they consider behavior that's going to better the country. Now, they're not always perfect at it, but they're not actually trying to design things that people can cheat on. And that is what people, when they use the word loophole, is trying to get that visceral reaction. So I think this
Bruce,
is a really important thing, because this comes up a lot with our clients. They can't understand how it works.
yeah, Bruce, I think that's really valuable where you talk about the difference in terminology, even between a tax advantage or tax benefit or tax incentive. Those are positive words versus a tax loophole makes it seem like somebody's getting off by avoiding or circumventing or going around the tax law. And it gives this negative, it sheds a negative light on the person taking those tax incentives by doing the things that benefit the economy. I think what's really interesting about this conversation today is that we're going to be addressing something that a lot of wealthy people, for various reasons, we're going to talk about the history leading up to this, were putting a lot of money into cash value permanent life insurance for the reason of tax advantages. It was very, very good. And the government then came in and said, well, too many people are putting money into life insurance. Too many wealthy people are using this as a tax shelter or a tax incentive, a tax advantage. and we're going to go ahead and close that window and prevent so much money from flowing in that direction, which then has to tell us it must have been pretty good. There must be a really positive reason for many wealthy people to be putting their money and holding it in life insurance. So let's find out why they were doing that and why that window was closed and what that can tell us about making decisions today that are benefiting us and putting us in a position of advantage. So if we go back to the 1960s, and Bruce, I know that we've talked about this so much on other shows, but life insurance was used as a savings vehicle for a lot of American families. I mean, this was whole life insurance was a common thing that people would put money into. They would store it in cash value life insurance. They'd be able to use the cash value or borrow against it and use that as capital to fund situations in their life. I mean, even in It's a Wonderful Life, that movie shows the main character using a whole life insurance policy in that way. And there's actually a quote back from somebody at the let me see, where do I have my quote here? So this was from Jesus Huerta de Soto, and this is talking about, he's a leading scholar on Austrian business cycle theory, and he talks about the idea of people putting money into life insurance policies. And he said, um, the social significance of life insurance companies sets them apart from other true financial intermediaries. In fact, the contracts offered by these institutions make it possible for broad layers of society, that means a lot of people throughout different economic stratifications, to undertake a genuine disciplined saving effort for the long term. So this is a savings tool, it's a savings effort, it's genuine, it is consistent, meaning that's where you're getting the discipline piece, and it's for the long term. They're having long-term planning as they're putting money into savings. He continues on and saying, indeed, life insurance provides the perfect way to save, since it's the only method which guarantees precisely at those moments when households experience the greatest need, which is, he says, in other words, the case of death, disability, or retirement, that the immediate availability of a large sum of money, which by other savings methods could only be accumulated following a very long, prolonged period of time. Now, this is a complex sentence that he's sharing here, but he says no other place can you save money in a disciplined way for the long term that as soon as you experience any of those events, the disability, death, or retirement, you're in a situation that you have capital to be able to infuse in that moment of greatest need. And he continues on with the payment of the first premium. The policy holders, beneficiaries, that's the people that you would pass the death benefit on to should you pass away, they acquire the right to receive, in the event of the person's death, for instance, a substantial amount of money which would have taken the policyholder many years to save via other methods. So what he's saying is not only was it a powerful, strong savings tool because it has good growth and it has the accessibility of the cash value, but it guarantees that at that moment of the greatest need that you provide to your beneficiaries this large sum of capital that no other savings vehicle can do that.
Yeah, it's what I always talk about, a leveraged up death benefit. So just like in real estate, they talk about having a small down payment, but you control a large piece of real estate. The death benefit works the same way. You make a premium payment and you suddenly have a large death benefit. So that's what he's saying is there's no other way that you can obtain this right away. Because if you're going to say, oh, I'm going to save it over time and I'm then going to accumulate this large chunk of money, well, it takes you a long time to accumulate it. What if you need it before you actually accumulate it? So that's
Mm-hmm.
what he means by that. And this is one of the things that is a negative about the whole buy term and invest the difference, because buying term might be systematic, but a lot of people don't systematize the investing the difference part. And so there's a joke that a lot of people say about it, it's buy term and spend a difference, where when you're actually having whole life, you actually are buying a death benefit that could be similar to term. And in some cases, there actually is term within the contract. And then the life insurance company is taking that money, making it work for you in their investments, and then sharing those investment returns with you in the form of a dividend. So you're kind of doing buy term and invest the difference when you're doing whole life, except it's systematized. So
Mm-hmm.
that's the big difference.
And the value here is that you're not just saying with term insurance, With term insurance, you're paying a premium just for the death benefit. But with whole life insurance, you have that savings component because you're building the equity inside the policy. And every time you put your premium in, which is going to be a substantially larger premium than you put into a term policy, you are building equity or you're building cash value that grows with guaranteed interest, the non-guaranteed dividends that are highly anticipated. And when that's happening, you have access to this capital, which is a completely different situation than just buying term insurance. In that case, yes, you get the death benefit, but you don't have any cash value. So, Bruce, this was until the 1960s, life insurance, specifically whole life, being a very popular, very commonly used savings tool. And basically, around that time frame, we ended up with a situation where when you looked at whole life or life insurance in general, whole life had about 85% of the market share. So of life insurance, they had the majority of the kind of life insurance in force was about 85%. So let's take a look at a few factors leading up to the lessening of the amount of whole life insurance and kind of some of the things that cause people to become disenfranchised with it. So in the 60s, there was a fixed ceiling of 6% interest rate on policy loans. And that was based on old English laws that carried over with some usury laws. And basically what that meant was you can borrow against your life insurance policy, but the life insurance company could never charge you more than 6% on cash that you borrowed from your life insurance policy. So that was fine for a while. But then we had the inflation you talked about. The Fed was trying to curb that inflation. They're trying to push down or push up long-term yields in the open bond market. They ended up in a situation where interest rates on bonds went up and people started using arbitrage to say, well, I can borrow from my life insurance policy at 6% and I can go make money in bonds, a safe location to put capital, and I can make more money in bonds than I'm paying on my life insurance loan. What happened because of that was that a lot of people are taking life insurance loans, which you'd say, well, that's a good thing, yes. But for the life insurance company, they're getting paid this 6% interest, and they had to keep a lot of their money in short-term assets so that they would have the availability to send that money over to the policy owners as they're requesting these loans. And so the life insurance company couldn't put their money into higher producing, higher income earning tools because they had to keep it available for the policy owners to be able to borrow their capital. And what happened as a result of this is that policy loans ended up taking up about 18% of the reserves of life insurance companies. And that was the highest that had been in place since about the 30s. What that means is that there's a big chunk of money being borrowed by policy owners, and that ended up becoming a detriment to the whole life insurance companies, because they couldn't put their money in places to earn higher growth rates. Bruce, is there anything you want to add to that kind of that landscape right there?
Well, just to go back to the fact that the reason there was massive inflation is Nixon took us off the gold standard in 1974. And so there could be we could print money. The Treasury Department could uh, issue bonds, and the Federal Reserve could print money, and then they could buy those from the Federal Reserve with IOUs for taxation. And then that was what caused the inflation. And when the inflation happened, this is really what led up to what you were just talking about. So I think that's important for people to understand that. And then also then when people were exposed to this new way of saving money into an IRA, where they were convinced that, tax deferred growth was good, even more money than that would have been put into insurance companies were now, instead of flowing into the insurance companies, were flowing into the IRAs. So that was another significant thing that lessened the amount of capital that the insurance companies had.
And when did IRAs begin, Bruce? Was that the same time as
In the
401ks?
same time,
So
74,
78, 74. Okay.
74, 79 then was the next significant thing. And that
Mhm.
was when the 401k came about. So now even more money is not flowing into cash value life insurance. So this is when then the popularity of universal life policies started to take on, because they were now going to be tied to interest rates of the bond market. And so now these interest-driven products were presented to people, and this is where we start the problem that the Tamra Act then was formed to correct.
Mm-hmm.
So then people started to see these high interest rates. Insurance companies started designing universal life and said, look, we're getting 12, 14, 15, 18% from these interest-driven universal life policies. So flow the money into this, put big chunks, single premiums into this. We'll keep the insurance as down as far as possible. We'll let it grow tax-free, and you can access it tax-free with very little insurance. And so this is what were happening. Not only did wealthy individuals do it, but a lot of middle class and even lower class people were doing it. So money was again flowing out of the whole life insurance. Well, then the Tamra Act came about in 1988, and Congress said, wait a minute, this is not what we intended life insurance to be. We want life insurance to be tax-free growth, access tax-free. However, you have to prove to us that this is actually an insurance product, not an investment.
Mm-hmm.
The reason we want it to be an insurance product is we want it to have significant death benefit in case something happens to a member of your family that that now that member cannot take care of the family, and now the death benefit will be large enough to take care of the family. So the state, i.e., either one of the 50 states or the federal government, does not have to take care of your family in the form of food stamps, rental assistance, welfare, so on and so forth. So it was once again trying to drive behavior where Congress was saying, we want this to drive behavior so we don't have to take care of it with taxpayers' dollars. We're going to take care of it by you taking care of it yourself. However, that's not what you're doing right now. You're driving down the death benefit really, really low, and you're using this as a tax shelter to access tax-free. And that's going to give us even less tax money for us to run these other programs. So that's why the Tamra Act came about.
I think what's really interesting about that whole thing is that when people start putting a lot of money into life insurance, especially the single premium life insurance that you're talking about, is that there was something else that happened around that time. You mentioned it earlier. I'm going to walk a couple of things up to it. So in 79, there was an FTC report that came out from the Federal Trade Commission, and being that that's a government agency, it was taken with a lot of weight, and it really kind of slammed life insurance, whole life insurance specifically, and said that there's really low returns. You shouldn't be putting your money here. And because of that report, there was a lot of publicity and a lot of feeling or government sentiment that the government knows what's best, and they're telling us that we should really be not using whole life insurance because of these low returns, which again, we're kind of trickling back to the whole cap on the fixed ceiling of the interest rate that was being charged for life insurance loans. And so that criticism from the FTC report really fueled a lot of this interest, or the disenfranchisement, I guess is a better word that I'm looking for, with whole life insurance at that time. So what happened here is that you're seeing negativity coming from federal agency, then you're seeing universal life gaining popularity, saying, hey, we can get better growth. And with the universal life, they're saying, hey, it's also more flexible, and hey, it's not so black box-ish. There's not so much mystery around how the growth happens inside those policies, and you're going to have more transparency. We're going to separate out the
The
investment
fees.
from, yeah. You're going to see the fees. You're going to have this transparency. You're going to see separate insurance from the investment portion that's growing in your side account. And because of all of that, there was just this glowing promise of what universal life could do. There was kind of a flight away from whole life insurance at that time. And then, Bruce, you mentioned the Tax Reform Act. Did you say that earlier? The Tax Reform Act
Yeah.
of
Of
86?
1986, yeah.
So what was interesting about that, this is coming, that Tax Reform Act of 86 with that, there was a lot of changes in the tax structuring. They simplified, they made fewer tax brackets, but ultimately they were trying to make it say it's going to be better for everyone, but they still needed to increase taxes because that's what government does. They need to continue to have additional taxes so that they can fund all the programs that they're doing. And so ultimately they removed a lot of tax shelters. That's when the whole negativity came in, and they call them loopholes, and we're going to close these loopholes so the rich can't skirt around them. And then there was also an increase in capital gains tax. I think it was up to like to 28% from 20 or something like that. And with those changes, there was a lot of challenges that happened in the real estate market. And so there was a crash in the real estate market as a result of all of this. Was the largest crash in the real estate market since the Great Depression. And then there was the US stock market crash as well on Black Monday in 87. That was October 19th in 87. So because of the challenges that investors were having in real estate and in the stock market, they're saying, okay, well, we need a place to park cash and store our cash. And that's really when they started buying those single premium policies that you're saying, Bruce, because they were saying, well, we need a place to be able to store capital. And they're saying, we're not getting the tax advantage. We're not getting the growth in these other areas that are being devastated because of the tax act, the tax reform act that changed a lot of the way the real estate market and the stock market was operating. So they're moving into life insurance. And the reason was there's favorable tax treatment, there's accessibility of cash, there's safety as opposed to volatility and market volatility. There's diversification away from that market, the market challenges. There was this element of guaranteed growth. There was stability. It was seen as it was this stable asset that had a lot of tax advantages. And the government said, wait a minute, you're using it like it's just a savings tool. We want it to be pure life insurance. Let's go ahead and close that opportunity. And that's when the 1988 Tamra law, which I think you said what that fully was called as well.
Yes, Technical and Miscellaneous Revenue Act.
Yes. So
TAMRA, Technical and Miscellaneous Revenue Act, TAMRA.
So, and it's now, I mean, you can usually seen it referred to as a Tamra law, which ultimately said, the government said, no, 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 you can't put as much money into this tool, this life insurance tool. You instead need to make sure that you can only put in X amount of premiums. We're going to put a cap on the amount of premium you can put in for that amount of death benefit and still consider life insurance to get these tax advantages. And so I guess when I look at that whole landscape and that whole conversation, there was a lot of reasons why very smart people were putting money into life insurance policies before the 1970s. So all the way leading up to the 1970s, and then also in the 80s when there was a lot of volatility and instability and insecurity in other markets. People were putting money into life insurance in both of those cases. And then you see the government saying, well, we need to prevent so many people from putting so many dollars in this place. It makes me realize and see, well, if it was so good, that's why the government had to say, hey, look, too many people are recognizing the value here. It's not as advantageous to us. The government are not getting as much tax revenue because people are seeing the tremendous advantages. We need to change something so people stop doing what's in their best interest tax-wise. And so that just shows me, I guess the lesson to learn from all of that is to make sure that you are finding the best place that is the most tax advantage, that you can find those tax incentives, that you are being aware of the tax landscape so that you're making decisions that will put you in a favorable tax position.
Yeah. And so just try to simplify this. Before the Tamra Act, you could do a single premium, or you could do multiple premiums, but you could do a single premium, and that single premium could actually have a death benefit that was less than the premium. And so as long as you did not let it lapse, then you could access it, it would grow tax-free, and you could access it tax-free. And then the Tamra Act.
Awesome setup, right?
Yeah. And the Tamra Act then said, no, we want this to actually be life insurance. So I always use this example, and it's an extreme example, but I think sometimes you have to go to extremes for people to understand. So let's say people were putting $100,000 in, but they only had a $5,000 death benefit. Well, the Tamra Act actually flipped it and said, if you put $5,000 in, you got to have at least $100,000 of life insurance being paid. And it's not that simple, but it's a complicated formula that the Treasury Department and the life insurance companies know about. And there's a 1 year rule, and that 1 year rule is the single pay I just talked about. You can't just do a single pay. And there's a 7 year rule. And the 7 year rule says that you, as long as you put premiums in, and then we're going to have a 7 pay test, you can only put this amount of premium in per death benefit. You can actually miss some of that 7 pay and catch it up the next year during that 7 year period, as long as there's not a material change to the contract. In other words, you didn't lower the death benefit, or you didn't increase the death benefit, or any kind of material change that might have really affected if you're really using dividends to buy more paid up additions. And so then after 7 years, the 7 pay test goes away. How that 7 pay test goes away. However, it can be reestablished again if there's any material change. So it has to start over again. And if it does not pass the 1 year or 7 year pay test, it becomes what's called a modified endowment contract, which we refer to as a MEC, or the industry refers to as a MEC, the initials of that. And that MEC now simply means that the growth inside, instead of becoming FIFO, first in, first out, in other words, your premium goes in first, you can take your premium back out, which means you're not going to be taxed on it. It becomes LIFO, last in, last out. So I'm sorry, LIFO, last in, first out, which simply means now the growth is what's the last in. So it's got to be the first out.
So you're
so that
taxed
becomes
when you take it out.
taxed on that. The other significant reason that you don't want it to become a MEC, first of all, the life insurance, I only know of one mutual company in the United States that I have heard does not notify. They put it on the client to make sure that it doesn't MEC. All
So
the
the
other
responsibility is on the client with
responsibility.
that one company.
Correct. All the other companies, if you send in a payment, they'll accept the payment because you can MEC a policy and there's reasons to MEC a policy. So they'll accept the payment. However, they will then notify you now that your contract has become a modified endowment contract. And you will have 60 days to correct that. In other words, all you have to do is tell them, hey, no, I didn't want to MEC my policy. Send back the excess premium to me. And they'll send back the excess premium, and it won't be. If you miss that 60-day window, it will now become a modified endowment contract, and you cannot reverse it. And what that means now is everything in the policy actually does grow tax deferred. However, if you access it by taking out the principal or growth, it's taxable. And if you're not 59 and a half, you actually have to pay the additional 10% penalty, just like a tax deferred growth. And you can't even access it through a policy loan. It's also taxable. So they eliminated that entirely. The only thing that still gets passed along tax-free is the death benefit. So that's one of the greatest situations why you would use it as a MEC, why some people still MEC policies, because you can get a lot more death benefit when you MEC a policy. And that way you can actually, if you're not going to access the cash, you can actually pass that inheritance to the next generation tax-free. The other way you might another reason you might MEC a policy is it would be like a good alternative to an annuity that's growing tax deferred, but it would actually get passed along and be taxable. So this way you can pass along your estate without being taxable. So that would be another reason why you would want to do it. And recently, because of the very, very low rates in banks, although it's come up, in the last 18 months or so, people were actually mecking policies because they could get a greater return at the insurance company, even if it was taxable, than they could get in a bank.
Mm,
So
hmm.
it was no different than storing the money at the insurance company, mecking the policy, having access to almost all your capital, and actually having access to more of your capital in year two than you actually put, just like the bank. So they were saying, hey, I can get 3.5% at the insurance company. I'm not getting anything at the bank. So they were making policies because it was the same. They were going to have to pay taxes at the bank, or they're going to have to pay taxes from the insurance company. So it's not that modified endowment contracts are totally useless. It's just that if you're wanting to access the cash during your lifetime, especially for the infinite banking concept, for financing, or for passive uh, cash flow in retirement, then you don't want to have a modified endowment contract.
I think one of the most important things that I think is a takeaway from this whole idea is that, or from the whole lesson, the layup into what happened in 1988 with the Tamra Act, is that if we use our lens of thinking about life insurance, that we want to put as little in premium as possible to get death benefit, then we're going to buy term insurance because that's the cheapest way to go about getting a life insurance benefit. But the wealthy were using life insurance completely differently. And instead of thinking about how they could put as little in as possible to get a death benefit, they were saying, how can we put as much money in as possible into this tool that we're getting a death benefit, we're getting all these tax advantages. How do we put as much money into that as possible? That, I think, was the positive thing that was happening before 1988, which the government then said, no, 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 you can't put that much money into this product and still get those tax advantages. That's really what they said. They said you can only put in this much per death benefit in order to still get the tax advantage. And so the lesson that I take away from that is we shouldn't be thinking about how can we put in as little as possible in premium to get the death benefit, but how can we fund life insurance with the most capital possible up to that MEC situation, that MEC limit, if we want to maintain the tax advantages, have that powerful savings tool and savings vehicle, and we just can't put in any more than what the government says we can put in, but we can put up to that amount for the amount of death benefit and reap tremendous rewards by having the tax advantages and a place to store cash and having the death benefit.
Yeah, I'd like to relate to this to Nelson Nash 5 tenets, where he says, think long range, okay, long term savings vehicle. Don't be afraid to capitalize. Okay. So both of those are what you do with savings vehicles. Now, this gets this gets confusing to people because they are on this hamster wheel about getting their money in motion, velocity of money, so on and so forth. And when they do that, they actually want as much capital as possible according to the modified endowment contracts in the shortest period of time. So what they do is they pull down the base contract of a whole life, and the base is the foundation that things are built upon. The higher the base, the easier for it not to be a modified endowment contract, because you get a lot more leverage of the ratio between the base premium and the death benefit. The paid up additions, the ratio is very small relative to the base, where the base might be 10 times, paid up additions for a younger person might be 3 times, for an older person, it might be 1.5 times.
And
So
you're
once
talking about
again,
the ratio between the amount of
ratio between
premium
the
going in for
premium
that portion and death benefit.
and the death benefit. And so that's what the modified endowment contract is saying they don't like. They want to have a lot of death benefit per premium. So whenever you institute a lot of PUAs, you're actually closer to designing the policy like a universal life policy. Because a universal life policy's whole premise was, we're going to let you give us the least amount a flexible premium, and then you're going to make all your money with the excess of that. You're going to make it on the interest rate. And that interest rate then is going to be able to buy more and support your premium payment. Well, what happened then was the interest rates came down, so that flexible small premium was not able to sustain the premium payments that they thought that they illustrated at 12, 15, 18%, and those collapse. Small base policies will do a very similar thing where they're relying on the PUA to buy more death benefit. But then if you access that cash that's readily available and you don't pay it back, now the PUA actually does not make enough money to offset the borrowing cost of your money.
Mm.
And this is something Nelson knew very, very well. He knew that humans will always, for the most part, have to overcome their human conditions and absolutely do the least amount they can to try to game a system. And so that's why he absolutely said, we do not endorse any type of universal life policy for the infinite banking concept. At least with whole life, if it's designed properly, and designing properly, there's not one single design, but you have to think long range. So people that are, and thinking long range means you're going to be funding this thing for as long as you possibly can fund it, maybe your entire life. Because if you're thinking short range, what you're saying is, I want my capital now. And the only way to get it now, in your definition, is to have very skinny base, very large PUA, and now you've brought in the same complications as universal life.
Mm-hmm. Bruce, I think that was a very depthful and eloquent way of helping us understand that if we think long term and we are willing to capitalize, we're willing to pay as much premium as possible, we're willing to put as much premium in for as long as possible, you're in an environment now where you're more interested in the long-term growth of your life insurance policy, which is going to put you in an advantaged position because you're going to have more growth, you're going to have more guarantees, you're going to have more stability, you're going to have more generational wealth. And because of all of that, that is the ideal way to think about whole life insurance, which is, again, the exact same way that Jesus Huerta de Soto was talking about using life insurance as a tool for disciplined habitual savings. So I think we've come full circle to the idea that we can use this as a powerful savings tool when we think long range. Bruce, I think this was a fantastic episode today. If you are interested in taking infinite banking to the next level for yourself, whether that means starting a policy for the very first time, whether that means converting term insurance into whole life, whether that means just looking at your financial landscape and figuring out what the next best move is for you personally to optimize your financial life, to have more stability, more security, more capital available to invest in your family, more just more peace of mind that you have a floor in your financial life, that you know you're not going to lose capital, you're wanting that protection and that preservation of capital, you can talk to us and figure out how to implement these ideas in your life with your financial situation. You can book a call at themoneyadvantage.com and talk with our advisors about your life. So thank you so much for being with us on this show today. We tremendously just hope that it was valuable to you. And in closing, please remember, success leaves clues. So